Greetings, welcome back to our February video commentary series. I'm Nik Schuurmans, partner and wealth advisor at Waverly Advisors. We're talking about the great rotation. What is out of favor is starting to work. What's been in favor is starting to work less well. The market, although people talk about how crazy it is, the S&P 500 has traded in a tight range thus far in 2026. But the bigger story is the rotation from what's expensive, U.S. large cap, growth, technology, software, into tangible assets. So we'll be looking under the hood at the market action thus far in 2026. We have some great slides to share. If you feel like you need to pause or zoom in on those slides, feel free to do so. Let's get into it. We've coined this commentary series the Great Rotation for good reason. So this is a chart of market action from the start of the year all the way through February 2023. We highlighted a few ETFs that are meaningful for our clients. So starting at the bottom up, the purple NDX, that's the NASDAQ Technology Heavy Index. You can see it's down about 2.3% to start the year. One of the worst performing equity asset classes, at least in the US. And then just above that, SPX in blue, that's the S&P 500. Again, if you could just track the blue line or even the purple line, it's been a pretty tight range, but certainly investors are starting to question the capital expenditures, the nosebleed levels that these companies are spending. And if you caught my post last week, I believe, I talked about the parallels between capital expenditures in the internet boom and today in AI. And although they're not the same, different economic background, certainly there was a lot of froth back in the internet.com boom and bust. But the early capital expenditure leaders weren't necessarily the winners. And you can go back to telecom in the 90s, to railroads back in the 40s and 50s. Companies that spend boatloads of money in capital intensive businesses, those stocks aren't often rewarded. So it's just something to be mindful of. The early leaders don't necessarily end up being the end game winners. Bonds have held pretty steady, which is nice to see. It seems like bonds have resumed the role of not only producing income, but when equities are down, bonds do well to maintain and mitigate drawdown. So that's nice to see. RTY, that's a small cap index. Small cap has been out of favor for pretty much the last 8 to 10 years. Small cap and small cap value, which is the orange, small cap value, SLYV, has done quite well. And again, it's simply a rotation into cheaper, less expensive asset classes with the focus on tangible assets. So when I say tangible assets, assets you can touch, think real estate, think gold, industrials, materials, consumer staples, things that have been out of favor. Investors are starting to rotate into those undervalued tangible assets. EFA, that's international stocks. Think Greater Europe, Australia, larger international countries. So continuing a theme last year where emerging markets, foreign stocks really took the baton from U.S. large caps. Not a lot of people talk about this, but last year, the S&P had a great year, but it was one of the worst performing global markets out there. And that theme is continuing again this year. And it has less to do with what's going on in politics or what's going on in AI or anything else you want to think of. In our opinion, it has a lot to do with the starting point. U.S. stocks are historically expensive by any traditional measure. And when you look at the opportunity set out there, whether it's real estate, emerging markets, foreign stocks, the risk return profile for those other asset classes that I just mentioned are much more attractive relative to U.S. large caps. SCHH is real estate or REITs. This is an area that we really like. It's a tangible asset, produces some income. It's been out of favor, and many smart, astute investors are starting to rotate into REITs, up about 9% this year. EEM, that's an emerging market index. So think India, China, Thailand. Again, a lot of these countries are export heavy in commodities, and commodities have been in favor. So again, that goes back to my risk return profile comments earlier. And then lastly, gold. Gold's had an interesting journey thus far. And of course, we've liked gold for a while. When you look at the fiscal deficits, the reckless spending, the monetary policy experiments, I think gold checks a lot of boxes in this type of macro environment. But this massive drawdown that you saw, followed by a little uptrend in February, was nice to see. But gold, again, checks a lot of boxes when you think about the debasement trade, fiat currencies, and the devaluing of those. Highlighting what's worked thus far, areas of strength, obviously green on the left, areas of weakness on the right. So this just puts a bow on top of what I was just saying. Let's start with areas of weakness. So domestically, the NASDAQ 100, that's tech, S&P 100, 100 of the largest companies in the US, mega caps, growth, technology, software, consumer discretionary, and then globally, China, India, and the US. So again, the US has been off to a slow start relative to the rest of the world. But this is something that we've been talking about for 18 months. And I've mentioned this before, but pretty much every prospective client portfolio that we look at, massively over allocated to the S&P 500, massively over allocated to the NASDAQ, and then they own these individual stocks outright. And many folks are taking a triple bet on a technology-heavy momentum index, so to speak, and they don't even know it. And most investors are hard-pressed to change something that's worked. And I just feel like there's a lot of complacency out there. And when you're massively over-allocated in one area, you're usually out of balance in others. And again, in our opinion, there's some great opportunities that the market is giving us beyond the S&P 500 in big tech. And then what's worked? It's pretty much everything that's been out of favor the past 7, 8, 10 years. Value, small caps, equal weight, industrials, energy, materials. So again, back to that tangible asset comment, many investors are rotating to real world assets. So globally as well, emerging markets, Europe, Latin America, the Pacific, all world ex-US. So this is an interesting dynamic. This is taking or continuing the theme back in 2025 where global stocks did much better than US stocks. It'll be interesting to see if that's a one-off or a continuing trend that we see in the years to come. Let's look at the sector level. So here in the left column, sector rotation, we have all the S&P 500 sectors, and the gray bar, if you can zoom in and see that, is the index weight. You can see the key at the bottom right. And then the year-to-date return is in blue or in red, depending on if it's positive or negative. So not to be a broken record or repeat myself, but a lot of these sectors that have been out of favor, industrial, staples, energy, utilities, materials, and real estate, are very much in vogue in 2026. However, as you can see, this gray bar on the right, or just under these dark blue bars, these are pretty small weights in the S&P 500, meaning when these sectors are doing well, it doesn't move the needle a whole lot. What does move the needle, if you can go to the bottom of the graph, is technology and financials. These are much bigger percentages of the S&P 500. And you can see with these red bars, many of these large sectors are negative. And that's part of what we've been talking about, the top heaviness of the S&P 500. And I've said this before. When someone's saving in their 401k and allocating $100 to the S&P 500, they might think they're buying 500 of the largest companies in the US. And that's partly true. However, these market cap weighted indexes are extremely concentrated at the top. So that $100 that goes in every month, 45 of those dollars are buying 7, 8, 9 technology companies with a heavy focus on AI. Now, that's fine if you know that. It could be potentially perilous if you don't know that. You're investing under the guise of diversification, but what you're really getting is a top-heavy market cap weighted index focusing on a handful of stocks. From an asset class level, tangible greater than digital, again, there's a rotation into real world assets. This might be hard to see and it might seem like there's a lot going on, but it's quite simple. So if you want to pause and zoom in, that might be a good thing. But this goes back to 2000 and you can see every box is a different asset class. And we've classified them by color. And it's kind of nice to see if you just track a color. So let's pick yellow, let's say, that's gold. You can go through since 2000 and see gold's journey. And what sticks out to me is that, one, it's really hard to predict the asset class that's going to do well. There's no asset class that persistently outperforms every single year, which is why we diversify, which is important. When you get these really good years in the S&P 500, there's a tendency to chase performance or look at what's just happened and extrapolate that into the future. Again, that's why we diversify. But looking at 2026, and certainly a month and a half does not make a trend, but gold, emerging markets, which are commodity export heavy, commodities, REITs, these are all tangible assets. And when you look at what's done well over the past few years, it's been digital, it's been AI, it's been technology. So that's an interesting trend that a lot of investors are paying attention to, including us. Tough to stay king. So this graphic charts the top 10 companies by 5-year periods. So this goes back to 1980. If you look at the far left column, 1980, you'll see IBM, AT&T, Exxon, GM. And what you'll notice is these were the largest companies back in 1980. These were the investor darlings in 1980. None of these are at the top in 2025. And this is not a prediction. It just goes to show you it's really hard to stay on top of the corporate mountain. What's popular today, especially in technology, can be quite fickle. Investor risk appetites can be quite fickle. Technology and AI changes very quickly. So while the Magnificent Sevens are certainly owned, some can argue they're over-owned. And in my opinion, and based on prospective client portfolios and positioning, many folks are shoveling money into these names thinking the last 10 years are going to look like the next 10 years. And again, if history is any lesson, the leaders on top of the corporate mountain often change, and they can change quickly and without warning. So again, we certainly like a lot of these names, but you want to be very mindful of your risk exposures, be mindful of your position sizing, especially if you're retired or about to retire. And not to beat a dead horse, but this is the law of large numbers, so think twice about chasing the biggest stocks. And what this is a graph from Dimensional. And they're tracking the returns in this light green color before joining the largest 10 companies in the US, and then after joining the largest 10 companies in the US. So the returns are best before a company enters that top 10 largest companies. And then after that, it's really hard to grow. And I always say this, but it's really hard for a $3 trillion company to become a $10 trillion company. So you're running into the law of large numbers. And future returns for these mega cap companies can be challenged as they grow in size. And that's supported by this. And it's also supported by the market action in 2025 and 2026. So this is the great rotation. Again, if you have any questions about risk management, position sizing, how to build a portfolio, if you have emotional or cognitive biases and you're freaked out if we get a 5 or 10% pullback, this is a great time to look at all of that. I mean, the market is at or near all-time highs. It's been a great run, but the next 10 years or the next cycle might not look like the last cycle. And this great rotation that's currently happening, I feel like a lot of investors are missing it, and they're continuing with the themes of yesterday. So if you have any questions about portfolio construction, risk management, shoot us a note at lakeoswego@waverlyadvisors.com. Thanks. We'll see you next month.